NVIDIA is now the most important stock in the AI era, but also the most expensive. Its valuation has reached a level we've only seen a few times in history. The dot-com bubble, the Cisco supercycle, and Microsoft's peak in 2000. So today we ask one question: is NVIDIA priced for unstoppable growth, or is history repeating itself? Welcome back to the Shorting NVIDIA series. I'm Alex, and in the first 3 episodes, we dissected their hidden depreciation risks, the threat of customer betrayal, and the squeeze from geopolitics. Now it's time for the pillar the bulls don't want to talk about: valuation, and how it compares to the biggest tech bubbles in history. Hit subscribe. This episode matters. First, let me make this clear. The question isn't whether NVIDIA will grow, but whether all that growth has already been priced in for the next 50 years. Wall Street always says this time is different, but history lessons are often brutal. Let's look at the numbers today. As of late 2025, NVIDIA's trailing PE sits at the mid-40s, while forward PE estimates are materially lower, around the low to mid-20s. That reflects expected future earnings growth. By comparison, Apple, Microsoft, and Alphabet trade in much lower ranges, roughly mid-20s to mid-30s. In other words, investors are paying multiple times the valuation of other mega caps for each dollar of NVIDIA earnings today. That premium assumes several years of exceptional growth, and it's why a re-rating would be painful if growth slows or reporting earnings are adjusted downward. Let's get back to the year 2000. Many call AI a gold rush, so we must look at the original shovel seller, Cisco. At the peak of the dot-com bubble, Cisco was the world's most valuable company. Its routers were the physical backbone of the internet, holding a position very similar to NVIDIA today. Cisco's PE at its peak was over 100x. Microsoft traded above 70x, Intel traded around 55x. At first glance, NVIDIA's 45x might seem less crazy, but remember, Cisco, with a PE near 100x, still crashed nearly 80 to 90% and hasn't returned to its dot-com high 24 years later. That's the real lesson. You don't need a 200x PE for a bubble to form. Even a correction from 45x down to 25x would erase trillions in market value. And don't forget Michael Burry's warning. He argues that part of NVIDIA's reported profits may look stronger than reality because of how depreciation and inventory are accounted for. If those costs were recognized more aggressively, earnings would be lower. And here's the key point. When earnings fall and the stock price doesn't adjust immediately, the effective PE shoots higher. A trailing PE in the mid-40s could instantly jump into the 60s or higher, placing NVIDIA firmly in historical bubble territory. Burry's argument is simple: understate depreciation, overstate profit. Overstate profit, inflate valuation. He's not predicting NVIDIA's collapse. He's saying this: a valuation built on perfect numbers and a perfect cycle leaves no room for mistakes, and no cycle stays perfect forever. The defense argues that NVIDIA has an unbreakable CUDA monopoly, that AI growth is certain, and that the 75% gross margin proves its superiority. But the rebuttal is simple. As discussed in episode 2, Google, Meta, and Amazon are spending hundreds of billions, and they're developing their own chips. They're actively finding ways around CUDA. The moat is being trenched by trillions in capital. Furthermore, a 46x PE has already fully factored in years of certain growth. Any quarter that misses expectations will trigger a catastrophic sell-off. Remember the Cisco lesson. They also had monopolistic tech and certainty. But when the investment wave slightly paused, the emotional premium vanished. So here's the final question: is NVIDIA the greatest growth story of our time, or the next chapter of a very old pattern? Option A: believe that this time is different, and that NVIDIA can sustain a 46x valuation by generating unmatched growth. Option B: remember the Cisco lesson and acknowledge that the AI revolution is not immune to bubbles, and prepare for a brutal valuation correction once market sentiment shifts from unlimited growth to rational pricing. For me, when I see a 46x PE facing the customer defection risks we laid out in episode 2 and the geopolitical pressure from episode 3, I see maximum risk with minimum margin for error. The number suggests the downside risks heavily outweighs the remaining upside. If you find this deep dive useful, please like and subscribe. Next time, we'll discuss NVIDIA's cash flow trap.